Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our April monthly market update a little bit early this month to address market volatility and tariffs. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. I'm sure we'll be addressing this and many other items at our quarterly investment forum at the end of the month. If you haven't already registered and are able to, please go ahead and do that. As it relates to market volatility, just to bring you up to date on where we are, the NASDAQ and the S&P joined as of Monday the 7th. We're officially in bear market territory, which means a 20% decline from a prior high. Keep in mind, declines like the ones that we're in aren't that uncommon. Never fun to go through, but on average since 1980, the intra-year decline is down 14%. Even though the annualized total return is an average of 12. And these are worst market days and what happens 1 year later, and worst market months and what happens 1 year later. And so what you'll see is the average of those declines is down 9%, and 1 year later up 31. The worst months average down 11.5 and are up 23.4. Now, the tendency is to always do this, to buy at tops and to sell at lows. We're going to encourage clients to not do that, but to reach out to us if you have any questions. So let's talk about tariffs, which are driving some of the volatility, although there were some things that were already outside of tariffs in the markets, very high valuations, very concentrated market performance, a slowing economy, but tariffs are definitely the things that are driving volatility today. So what are they? They're taxes on imported goods. They're used for a number of different reasons: encourage domestic production, revenue, reduce reliance on foreign goods and services. Their potential impact is inflationary, trade relationship with other countries, and may have an impact on economic growth. For our purposes today, we're not going to talk about pro or con. We're just going to talk about market reaction. So as it relates to rates, and this is a very long chart, but it talks about kind of what our average rates have been. I'm going to take us through the last 100 years, going back to in between World War I and II at 25%. Now our average tariff rate with other countries is 2%. And that matches the tariff revenue as a percentage of total receipts. So it's been much higher in the past and is very low today. And as you look at the new tariffs that have been put in place, our average tariff rate is just over 3%, so pretty low compared to our top 10 trading partners. And if you look at our exports as a percentage of our GDP, you'll see that we're 11% versus a much more export-dependent economy like Germany, Mexico, Canada, et cetera. So what are some of the unknowns as it relates to tariff policy? The first one is, are we at the end or at the beginning? So is this a negotiation or a final answer? Part of what's driving market volatility is just the uncertainty attached with which one of these is true. Are we in a controlled burn or a wildfire scenario as it relates to tariff policy? And this uncertainty brings with it volatility. We're going to talk for just a second about kind of first and second order effects and what else is going on. So first order effects is it does raise revenue for the country imposing, but it brings about inflation risk. So the cost of goods and services, if all other things are equal, go up. It enhances domestic production, which could be a national security item. For example, 70% of the world's semiconductors are made in Asia. Much of that is in Taiwan. So those are kind of some first order effects of current tariff policy or tariff policy overall. And some second order effects are as listed here. So we get a response to tariffs with other tariffs. And so you're in kind of a tariff or trade war. The recession risk is higher. So a lot of what the market is pricing in now is a greater chance of recession than prior. So JP Morgan has this at 60% as of now. you also kind of a second order effect is that you reduce efficiency. So protectionist policies that protect domestic production can disincentivize efficiency. You've also got currency, you've got interest rates, which we'll talk about in a second, and you've got a wealth effect, which is if financial assets are worth less, then that drives behavior, which impacts GDP, recession, et cetera. So what other things are going on? So one of the things that you see in interest rates is that we're down to below 4%, whereas we were at 4.8 just in January. One of the interesting things as it relates to interest rates, in addition to borrowing costs for individuals and for businesses, is the government, which has to finance between now and end of September, $9 trillion worth of debt. We've talked about this before, just over 36 trillion in debt, this 9 trillion due in 2025. And so according to the Treasury Secretary, each basis point, which is a 1/100th of 1%, saves the government $1 billion a year. So a 30 basis point decline, which is what we've seen since the tariff policy was put into place, is a potential of $30 billion in savings. So that's not the headline that's being followed today. It's just market volatility because of tariff uncertainty. But that's another thing that's going on. In addition to this, is WTI is trading at sub 60 today. So that's another thing to follow. Not only did OPEC increase supply, but on the basis of expecting lower demand because of an increased likelihood of a recession, WTI is trading lower. Another thing that's going on is the likelihood that the Fed will be more responsive this year. So the chances of 3+ cuts have gone way up. You'll see this yellow line here up to 53%. So one of the things to follow is, based on everything that's going on, does it put the Fed in a position where they're more likely to cut rates this year? Also, again, this is something that nobody's following, but Friday was a really pretty good jobs report, 228 added versus 140 expected, although February and January were downward revised somewhat. We will be sending out trade notes soon about an upcoming rebalance that will reflect what's going on in markets and tariff policy, et cetera. And then just a reminder as we zoom out, this looks at 100 years in the markets, and it talks about the markets in good years and in bad years. 73 of the 100 years in the just under 100 years in the market were up, and an average return up 21.5%. The average down year, all these 26 negative years were painful, were down -13. So the point of this is that the momentum and the frequency is on the upside of markets. So going through markets like we're in are always tough. Again, we're here to serve you. We want to help kind of walk through markets like this with you. If you have any questions, please contact us. We hope to see many of you in just a few weeks at our quarterly investment forum in April. Again, we encourage you to call us if you have any questions. We'll be in touch with you about upcoming rebalance, and we're here to serve you. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. Please reach out to us if we can help in any way. Until we see you again, be well and take care.